Hello and welcome to On the Mark Financial Literacy with Mark Zinman. We're very happy to have Alicia and Pudgy with us today. Hello.
Hi, good morning.
Good morning.
Can we get Pudgy to say hello one time, maybe?
Pudgy's sleeping next to me with his little paws, his little face on his paws. And of course we have Mark with us today. Hello, Mark.
Good morning.
And we're super excited to have Stephen Bowles with us today. Stephen is the owner of Catalyst Advisory. Stephen works with high net worth clients and retail life insurance. And today, Mark and Stephen are going to have a multi-part conversation about buy-sell agreements. Yes?
Yes.
So, Stephen, perhaps you could tell our viewers and listeners a little bit about yourself and your professional background.
Sure. So, Stephen Bowles, I own CatalystAdvisory.io. And I've owned that for the last 3 years, independent life insurance broker, and I also work with high net worth families to help them plan and disinherit the IRS. And then for 7 years before that, I worked inside of a family office, specifically working with high net worth families that had estate tax concerns, putting strategy together to move wealth to the other generations with the least amount of tax friction.
Wonderful. Well, we're very grateful to get your insight today on buy-sell agreements. And to that end, Mark, do you want to get us started?
Okay, so good morning, Steve. How are you
Good
doing?
morning.
How are you doing?
It's good
And
to see
we're going to see each other tonight. We have a
right.
Christmas party to go to tonight. You know, I always tell my clients, like, the most important thing is how to start a business, and the second most important thing is how to get out of a business. So with buy-sell agreements, who should be having a buy-sell agreement? Mm-hmm. Why should they be having a buy-sell agreement?
Yeah, any business that has more than one partner needs to have a buy-sell agreement. And it's one of those things where if you don't address it at the beginning, you're probably not going to address it later on, and you don't want to find out that it was too late. It's very important.
So it's sort of like a will in that way, right? Because like you want to make sure that if something happens, this will happen, and you don't want to leave it perhaps up to your spouse or spouses to
Absolutely.
deal with it.
Yeah, the ongoing theme I think that we're going to see in this conversation is around how do we ensure harmony. We want harmony when there's transitions.
So tell me what the discussion between partners should be, because it's always like, we only have a business, we only did this, why do we need this? Mm-hmm. So, and I know, there's a shareholders agreement, which will help discuss the management of company. Mm-hmm. What we're really talking about is a buy-sell where it would be triggered in what?
Good word, because you want to look for specific triggering events, minimally death, disability, and retirement. What's going to happen in those events? And when you're young and you're starting this business out, you're not thinking about those things.
Could I add a fourth one, withdrawal?
Withdrawal, yeah, there's more.
Okay.
Yeah, those are the big three.
Yeah.
But then there's withdrawal. If you have a business that relies on a professional license, what happens if a partner loses their license? What happens if they cross the law? All of these things, there's additional things that can be covered in that, but the big three are death, disability, and retirement. And if you don't have those kind of covered, then you're setting yourself up for some lack of harmony if something were to happen.
So I guess my question is, and this comes up a lot with clients, does the value at death have to be a formula, or can the value at death be a different value than retirement, withdrawal?
So, ideally, you're going to have the same methodology for doing valuation no matter what the triggering event is. And again, it goes back to that harmony. The time that these are all emotional events.
Absolutely.
Obviously, the different emotions, retirement might be happy, but it's still emotional, and you're still relying on the value of that business, most likely as your largest asset, to take you into retirement. So the time to really be agreeing on what the value of the business isn't during an emotional event. So there's different ways to do the valuation methodology, and that should be documented in the buy-sell agreement, and that can be a separate agreement or it can be part of your operating entity. So common would be, a lot of people will say, hey, we're agreeing upon the value of the business. Okay, that's great. Well, what about next year? What about 5 years from now? What's the value of that business? So that's one metric. I find that to be a weak one.
I do too, because I tend to like formulas.
Yes.
No matter what the formula is.
Yes.
I like a formula because it's easily calculable on growth or contraction of the business.
Yes. And if you are relying on a stated value, you better be updating that every year.
Nobody is going to.
Nobody's
I'm going to share with you.
Nobody is doing
You probably have the same
Yes.
experience I do as an accountant and
Yeah.
in your profession, is that it's like in a drawer, and unless there's some triggering event to look at it again, it's the same with the will. Like,
Yes.
just as a comparison, we just went on a trip, my wife
Yeah.
and I, and it seems that every time we take a big trip, it triggers looking at our will.
Absolutely.
So we haven't been on a big trip for 7, 8 years. We looked at our will. We made a small change. I actually had a meeting yesterday with another client, with our estate planner, and I told him that we didn't die. So we didn't really need to use that change. But yeah, the only thing, it's got to be some triggering event that's going to cause you to look at it.
Yes.
So yeah, I think we're in
Yes.
agreement that a fixed number is going to be the worst way to value it, because it's going to be unfair to someone.
It's gonna be unfair.
Because it'll change later in the future.
Absolutely. Yes.
Maybe not in a year or two, but 5 years from now, it could be considerably different.
5 years from now, and then you've got instead of saying like good, better, best, I'd say that's worse. Better would be formula, an agreed upon formula, multiple of EBITDA, something that can be objective.
So which you see more often, a multiple of EBITDA, free cash flow, or a percentage of sales? Like, what one do you see
So
most often?
most often when I see that as the documented amount, it's a multiple of EBITDA.
Okay. And did they actually use the word EBITDA?
Yes.
Okay, so I'm just going to explain. I'm just going to explain from an accounting point of
Yes,
view.
yeah.
I personally don't like EBITDA.
Yeah.
So EBITDA is earnings before income tax and depreciation. Okay. It is a GAAP term. GAAP is generally accepted accounting principles. 99% of small businesses operate on the cash method of accounting or a modified accrual method. So the difference between cash accounting and accrual is the recognition of receivables and payables. So if you're on a cash basis, you recognize your revenue when you receive it, you recognize your expense when you pay it. If you're on the accrual basis, you recognize sales when you do them, and you recognize expenses when you incur them. So there's a time difference, but neither of them are GAAP. GAAP has a lot of things to it. It has restrictions on how you depreciate assets, like there's no accelerated depreciation, there's some lease accounting, there's some stuff like that. So I do a lot of M&A work, and so a lot of times when you have Wall Street or financial money or VC money come in,
Yes.
they're going to go to EBITDA. And they sometimes, a lot of times, have to hire like a big 4 or top 50 firm to convert the books and do an audit to convert it from cash or whatever your modified cash is to EBITDA. Most small businesses, when they actually retail sell on multiples of cash flow. Would you agree? So a lot of times I would think that maybe if you're going about worst, better, best, the best formula would be free cash flow plus seller discretionary expenses, the same way you would get
Yes.
to a sale price plus a multiple. Would you think
Yes,
that's the best
yes.
way to maybe doing it?
And one of the challenges with any of the Formula One is you've got a formula there, but are you actually ever running that formula to see what your business is?
And you're more likely, in my scenario, and I think you agree, to run a free cash flow one. And free cash flow, just for the definition, is you would take your net income per your tax return or per your books. You'd add back depreciation, interest, and amortization, because they're not recurring, on a debt-free basis. And then you would add back, like, if there's any expenses that are on the books that you would not have occurred if it had been run by, say, by an investor.
Yes.
Okay?
Yeah.
But you have to allow
Yes.
for, one of the ones we get involved, you have to allow for replacement labor costs. So maybe you're paying somebody $100,000, but you could get somebody to do it for 60. You have to
Correct.
at least include the 60.
Yes. 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 And so then the challenge is, well, what's the value of the business on a regular basis? And then how do you plan for that? So if you're thinking about retirement, you need to have an idea of what's your exit going to look like. And so you need to, if you have a formula, you need to be running the formula and get that updated valuation number in your head so that you know how to plan for that way in advance. Because generally your largest asset.
Well, we also don't want, so you do a buy, sell. Oh, let's go through the three. So
Yeah.
death, I guess, is the easiest.
Well, there's one more valuation
Yeah, I'm
piece.
sorry,
So the ideal one is to say, hey, we're agreeing to hire a formal valuation company.
Okay.
So it takes all objective, the objective aspect is there. There's no subjectivity. We're going to hire somebody. This is all they do. They do valuations, and we allow for 2 or 3. So if there's a conflict, we're going to get 2 or 3 valuations, fair market value, done. So that's really the ideal.
Suggestion.
Yes.
That's even better than what we were talking about, having somebody else do
Yeah.
it.
I mean, so
But that's how they would.
That's your best.
But that's how they would probably do it, but in a more objective.
In a more yes, they might use one of those methodologies. They might do a different methodology. They're going to be looking at the broader market and say, here's how businesses like yours are valued. And by the way, it's going to be substantiated enough to submit to the IRS. And if there's an estate tax concern, so on and so forth, you're going to be using a formal valuation. So why not get that in the documents ahead of time and agree on it and say, that's how we're going to. It doesn't matter what you think. It doesn't matter what I think. We're going to agree that the third party determines that.
Agreed.
Yeah. Yeah.
And so I'm just again, people do that in real estate too, right? So if you have a piece of real estate and it's a divorce or an estate, you have to get it valued by somebody independent. I think this is worth this. They think it's worth that. Well, what is a person who doesn't have any skin in the game think?
Correct. Somebody who's just getting a check that does this all the time. What do they think?
Okay. So now, should we run through the triggering events that you talked about?
Sure.
Okay, so
Yeah.
death. I started out with death and.
Death's the most obvious one. I mean, it's a clear. There's a passing of a partner. Now what happens? What happens to the business? Obviously, the business is going to deal with the loss of what that partner was doing within the business. There's a settling of the estate for their valuation. So those are important pieces. Then we move into disability.
Well, let me stop here for a
Yeah,
second.
sure.
So, is life insurance the best way to normally fund death?
Life insurance, obviously I'm a life insurance
No, I
broker, so I'm biased towards it. But what I do like to see, even when because there's ways to do life insurance wrong with buy-sells, so
Okay.
we'll definitely talk about that as well. But what I like to see is there other language that's your catch-all if life insurance is either not in place, has lapsed, or is not enough? And I like to see installment sale language in there. So that's really important. I want to see evaluation. I want to see triggering events, valuation metrics, and installment sale language. Installment sale language is simply saying the company can sit there and is laying out what type of payments they will make on behalf of the company to
determine the value, but the company has the ability to pay that value over a period of years or months.
Correct.
And usually includes interest.
And usually it does include, because you're talking about future value, present value calculations, because otherwise the business will either have to fund it out of cash flow, which is what you would do with installment sale, or they'll have to take on debt. So nobody knows when a partner might pass away, so you don't know the financial health of the business at that moment and for the next few years.
And so
you need to kind of make sure all of your options are on the table if that event occurs.
So, in the event of a sudden death of someone,
Sudden death.
there's no planning. So, depending on what that person's role is with the company, it could interrupt the sales and cash flow of that company. It could interrupt the potential profitability of that company. So, the best way to obtain value, if it's not for life insurance on death, is to provide the company an opportunity to have a ramp to pay out.
Correct. Yeah. Now, obviously, the valuation was already determined, though.
Right.
So if the loss of that key person, that owner, affects the ability for the business to continue to thrive, an installment sale is going to be a challenge.
Well, that's an interesting concept. That's an interesting concept. So, I'm thinking more in the professional services, or in a service where the owner is providing services. It could be a plumber.
Sure.
It could be heating and air. It could be an accountant like me or you. And we have partners. Typically, the value of a business, if you were selling it, is going to be based upon it in the hands of a third party, and then there usually is some continuity of management in order to transfer that flow over. Here we have a sudden event. Does that normally change the value? Like if we as partners agree on hiring a third party to do evaluation under this method and this criteria, does my value being subtracted from the company affect that value, or are we going to say that value was the day before I died?
Yeah, so that valuation is going to be based on the business, not necessarily discounting for the loss of that partner.
Okay, so it'll be more historic.
It's going to be more historic. So yeah, in fact, they are going to look back at the history of the business.
I only want to point out because we mentioned we could and you and I both said there could be some impact to the business for the loss of that person. We don't want necessarily an unintended consequence of impacting the buyout of that family.
Correct. Yeah.
Thanks, Mark and Stephen. We're going to pause here and pick up where we left off next week. All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.